Hi, this is Pat Moore, and we are live with the 6-5 podcasts. 6 topics, 5 minutes each, all analysis, only enough news to give context. We are back from Vegas. Daniel, how are you doing, my friend?
It's like we're out of practice. It's been so long since you and I have been on the air together. I didn't even know what to say. I'm doing good. As you can see, I'm in my beautiful studio in Nashville, Tennessee. Also known as the Fairfield Inn and Suites in downtown Vanderbilt. In case anyone wants to come visit me, I want to give my full location to everybody out there.
By the way, you're going to have to look that up on Google Maps. I have no idea where that is. It was pretty cool yesterday. I flew in back from AWS reInvent after doing 15 6-5 interviews. And by the way, being analysts, which is truly our bread and butter. And we landed long enough for you to pick up your family to go to Nashville, which was good.
That's great planning, Pat. You just got to kind of have that planned out. You get to the airport, the family meets you at the airport, you catch the next flight. So it's the life. But
no rest for you.
No rest. Well, it's family stuff. You gotta knock that out every once in a while. So I'm happy to be here. What a great week, Pat. I mean, we really did stay busy. A lot of times people don't know, but we've got our firms as research and analysis firms, and they're both very busy. And then you and I have this media company, the 6-5, and it is absolutely exploded. What did you say? We did our 50th on the road.
Yeah, 50th on the road. Yeah.
And gosh, we've got to be getting up to what, 700 or 800 episodes all together with the summits and with, it's
including supercuts. I think that's exactly where it is. We've got to do something about in the booth. I think we only have 15 in the booth. So we're going to have to step that
up.
Get on
it, everybody out there. Book it up.
That's right. So let's dive in here. A little reminder. We do talk publicly traded companies, but please don't take anything we say as investment advice. We have some pretty awesome topics today. In fact, we're going to be talking a lot about AWS reInvent. Dan, you and I spent, again, over 3 to 4 days there. And we're going to talk earnings, tech earnings, Marvell, HPE, Pure, Dell, and Salesforce. And also with Salesforce, we're going to be talking about the potential impacts and reason for Brett Taylor, CEO stepping down, second co-CEO in 18 months, I think. This is going to be a fun one. Probably not a big a deal as everybody thinks. But hey, let's not prefetch that. Dan, I'm going to call my own number on this one. We're diving.
You love to do that, buddy. You love to do that. It's your show.
I love it. I do like to do that. But you know what? There was so much content. We would need 10 people on here to kick this off. So I'm going to hit a couple areas. So I'd like to set a little bit of context. And Dan, this might sound a little bit familiar, but we're 15 years into the cloud. And most 15-year-olds are not that mature, but they're out of those gangly 13-year-old age that all of us were in. And the great thing is choice that's out there, and the amount of partners that's out there is immense. AWS has the clear advantage in IaaS, around 50% market share. There is the PaaS and the SaaS market that other people have as well. Not a whole lot of talk about multi-cloud, but I wanted to give a little bit of editorial. This is less about AWS and more about my belief systems, is that multi-cloud, just like hybrid, is not debatable. Companies use multiple clouds for IaaS. In fact, I even talked to a Fortune 1000 CEO that didn't use more than one cloud vendor for IaaS and PaaS. So really the only debate is how you manage those without having separate DevSec network ops teams per cloud. You can check out some of the stuff I've been talking about on Twitter and LinkedIn about that, but that's the one area I'd love to see more definitive messaging from AWS. And listen, this is not the shill show. There are pluses and minuses with every show and every vendor, and it's easier to do this when that vendor has 50% market share. AWS is the market share leader in AI and ML. And I felt that the company's doing a really good job answering the questions or the challenges of data sprawl, quality, governance, lineage, security, lack of reuse of even AI algorithms and learnings, auditability, complexity, transparency, cost, and performance. I do think they need a little bit more investment in on-prem. You cannot get these services as part of their hybrid solution. AWS and IaaS compute, I mean, not only are they the market share leader, but they have the broadest view holistically from left to right and then top to bottom. You want the highest performance per watt, we got it. You want the lowest cost, we got that. A lot of our own homegrown stuff. A lot of different types of compute, even though we like to smush them together. General compute from a CPU, inference, training, and even network offload. They provide their own processing units, but also have leading instances from AMD, NVIDIA, Habana, and Intel. And, I know Habana is part of Intel, but I don't want people to confuse that they only use Intel CPUs. Habana is very much an Intel-owned training part. Probably most impressive, though, is what they've done with their homegrown silicon. And we had an incredible speaker on the 6.5. Gotti, check it out if you can, talking about Graviton, Inferentia, Nitro, and Trainium. Dan, 10 years ago, I would have never said that a vendor that did anything other than chips could do good chips, but AWS does its own good chips. And it's not just containers, it's VMs, it's containers, and it's serverless. So props to the company on that. It must be very hard to compete with AWS on compute. Because no matter how you pull this thing, they seem and appear to have the lead. By the way, this is what is making the alternative companies like Ampere Computing so popular with Google Cloud and also with Azure and Oracle Cloud. But again, I'm going to leave. There's a lot more oxygen I left you in the room, Dan.
Yeah, this is one of those topics that we could have done an entire show on had we not done 7 hours almost of recordings with AWS folks on the 6.5. I would have said we should, but instead what we should do is put in the show notes the links to all of them so you can check them out, because we talked containers, we talked homegrown silicon, we talked sustainability, we talked about AI and ML a lot. And if those are things that you're interested in, I can't beat it here in a few minutes. What I will say is there's a couple of themes that are really important and noteworthy. The first theme is clouds are not all the same. And there seems to be this overarching desire to make IaaS, because it's to some extent, when you're just talking compute network and storage, you can create what's called this concept of commodity, and it's not a commodity. AWS, between what Pat talked about with his homegrown silicon, when you talk about with their AI/ML services, when you talk about the overarching services for different instances in compute with their hybrid cloud approach, you get differentiation across the business, and that makes the company different than Azure, and it's different than Google, it's different than Oracle. And by the way, all kind of approach the pricing different too, of consumption and how businesses are going to be able to move to these clouds and stay with these clouds. So noting that is AWS has the most comprehensive suite, especially when it comes to the infrastructure itself. But the extensibility, like you said, of like AI/ML. A lot of people mention another cloud, which, by the way, has done a very good job for being the leader in data services, but they're actually not yet. And we'll see where that actually lands. The second thing is multi-cloud is here, period. You use this stat a bunch of times in some of our videos, Pat, but it's like 100% of big enterprises are multi-cloud now. And I'm not just talking about multi-cloud because they happen to be using a SaaS application somewhere in the org that sits on another public cloud. Every company is doing some version of multi-cloud for governance, for data residency and sovereignty, for redundancy. There's a lot of resiliency. There's a lot of different reasons that that's being done, but it is being done. And I think AWS has arrived there. And that's something that took a while for the company. It wasn't fast to get to. It was slow to get to hybrid cloud. It was slow to get to multi because, obviously, this goes back to the cloud denier era. And you and I have talked about this quite a bit. There was a period of time where the growth was so fast that people actually believed that every workload would be in the public cloud. And we're finding out that's just not going to be the case. And so AWS is doing a good job of building a diversified portfolio. So I want to talk about one more thing, because I know you love this topic, because I want to talk about sustainability. Sustainability is not only near and dear to your heart, Pat, but it's near and dear to the hearts of most organizations. And it's worth noting. It's worth noting for this, everybody out there, that I care about sustainability through the lens of economical, meaningful, and measurable. So we had a problem over the last couple of years where greenwashing became prevalent. A lot of architecture, a lot of talking about green for the sake of being, using it to drive business momentum. But what I like about what the company's done with their water positive announcement, and also what the company is doing with their homegrown silicon, is they're actually building technology that meaningfully reduces the utilization of power in the data center, which is going to be massive with the growth of compute. And they're trying to do something meaningful to the world, which we just left Las Vegas, Pat. And by the way, there's a lake drying up there. And it's a pretty significant problem that we got all these great hotels, but we might not have water. So, AWS is doing a lot of things well. It was a great event, high energy. You and I, you couldn't help but smile seeing all the geeks running around, because the event, like we said, 75% geeks and 25% wannabe geeks. So great event, Pat. We could talk a lot more about it, but we have 5 more topics. So I'll pass the baton back over to you.
Yeah, let's jump into some earnings extravaganza. And again, we cover earnings because it's ground truth for what's actually happening, and companies can lie less and market less. I say lie less with I'm just joking, of course, but market less has to be closer to ground truth than marketing, because of all the fun SEC implications. So let's dive in. Put your helmet on, everybody. We're going to crank through 4 earnings here. Marvell, go.
5. I think it's 5, but yeah.
But you're right, 5. I can't count. Appreciate that.
It's all right. It's hard. So Marvell suffered a similar fate to AMD, Intel, and NVIDIA, in the sense that the company growth slowed this quarter. By the way, not terrible, but actually record revenue, but just not fast enough for the street and their desire for the company's growth. They came in over $1.5 billion, 27% year-on-year growth, but came up a little short from what the street had hoped for the company. And then their guidance also came up a little bit short. I'm going to say this again. I'm going to say this now. I'm going to say it again. I've been saying it for a while. Marvell has had an amazing couple of years. And of course, some of what happened in the pandemic fueled its growth, pull forward. But the inventory issues did not escape any company. And despite the fact that Marvell is well positioned with minimum exposure to the consumer business, thanks to Matt Murphy's leadership and the turn of the company to be more focused on, the segments like cloud, 5G, enterprise, automotive, they still weren't completely able to escape the fact that companies did stock up, and they stocked up, and now they're burning off inventory with slowing demand. We're seeing the inflation number turn this week. We heard from the Fed. This could be a good news, but this is that inflection point. This is that moment. And for Matt Murphy, it was the time, and his team, the time to guide down temporarily, get the street's expectations tempered, and then hit the reset button. But I want to be clear. I mean, record revenue, 32% growth in data infrastructure, still guiding to 32% growth. This is not a company, in my opinion, that anybody really should be worried about. This is a byproduct of the overall broader market conditions. I mean, a couple more stats, Pat. 52% year-on-year enterprise network growth, carrier infrastructure up 26%, automotive and industrial revenue up 26% for the quarter. So again, a lot of things going well for the company, but this is the conditions that the market are facing right now. Everybody wants guiding up, can't always guide up. Sometimes you do have to reset. And this has been a quarter for a lot of tech companies to reset. Semiconductors not in vogue, but you know what? You can't run any of this software on air. That's why we like what AWS is doing. That's why I like what Marvell is doing. And I think this is more of a blip than a long-term problem for a company that's doing most things right. And by the way, we'll be there next week for their industry analyst day. We'll hear more.
Yeah, Dan, I was going to say we're going to be able to get underneath this because, and I had a little bit of a challenge trying to simplify this, because when I see all the infrastructure plays like Cisco, HPE, Lenovo crushing it on enterprise, and then I see Marvell going down, I still can't completely foot that yet. And maybe it has something to do with inventory that the infrastructure OEMs were sitting on. I need to go and do a little bit more work on this before I weigh in on that. But what I do want to stand back and remind everybody that in 5 years, their stock has gone up 89%, and that includes the doldrums of this year. The stock went as high as $88 before the big crash of 2022, and I think that is a testament, first of all, to the superior leadership capabilities of Matt Murphy and his team, but also some pretty decisive actions, shedding 90% of its consumer play, acquiring 2 to 3 companies, not only just to, listen, you never, I mean, padding is the wrong word, but to add short-term revenue, buying companies like Inphi that has it set for the next 5 years, moving from copper to light. So I like what the company does. I like its focus. I like that it's hanging in there and hanging in there, not in a point of weakness, but up there competing head to head with companies like Intel, NVIDIA, Broadcom, and now AMD with its Pensando play, and some of the ways that its FPGAs are competing in this same space in like 5G. So looking forward more, Dan, you and I have one-on-ones that are set up that I'm looking for. It's been about 6 months since we touched base. I've touched base with Matt, but overall a really good play. Let's move into HPE earnings. I mean, listen, what can I say? They absolutely crushed it, okay? And something good is going to happen when in the subhead or the heading of the press release, it says the word records, okay? They beat on the top line, second highest quarter revenue ever. They met earnings expectation. Revenue overall was up 12% in constant currency. But I think even more impressive is what the company is trying to do in its as-a-service areas, which was up 33% for the quarter in constant currency, and ARR up 25%. Those are freaking great numbers. But hey, let's talk just product sales. Compute up 22% at this incredible margin, around 15%. That doesn't mean that they're growing by going after some of the low-end business that some of the other vendors in this space go after. They did it with what they call value, which is high-margin business. So growing at the top line with an obnoxiously awesome margin, I absolutely love it. Edge came back. I mean, here's the thing. Edge has been a little bit off. And by the way, a very easy explanation. People were huddled inside of their homes and they weren't going to the edge. They weren't going to theaters. They weren't going to retail. They weren't going to banks. They weren't going to stadiums. But most of the world is back, baby, except for China. And the Aruba folks saw a 23% growth on that. Probably the only blemish that I think needs a little bit of explanation is HPC, off 11% in constant currency. And it's like, well, wait a second straight quarter. It's all about one thing. It's about Frontier supercomputer, that they cannot recognize revenue for that until the DOE says, yep, up and running 100%. We're good to go. I have a feeling we're going to have one monster quarter. It's probably going to be 50%, but we'll see. That's it. Good stuff. Congratulations, Antonio, to you and your team. I feel like it's very safe to say that the strategy is working. And I'd like to see the company continue this for the next 2 or 3 quarters, so doesn't look like an outlier. And final note, sorry, Dan, every one of these record-breaking numbers also were included shutting down Russia and Belarus, which for HPE, it's a big deal. I mean, it is not some rounding rounding number. Gosh, take me out of misery,
Error?
Dan.
Rounding
Yes.
error. Yeah. I'm sorry. This record is broken. We are no longer playing. You are watching a recording. Pat, look, I got to do a victory lap here. I don't normally get things right, but when I do get things right, I really get them right. And so I actually wrote a Market Watch op-ed piece a week before talking about the return of old traditional legacy IT. And yes, I'm sorry, HPE, IBM, Cisco, Dell, anyone that feels that we're being critical. I'm not being critical. What I'm really saying is that, well, for the past few years, we've had this sort of everything's going to go to public cloud, everything's going to be SaaS, everything's going to be these kind of new cool snowflakes and everything, and we're gonna put all our infrastructure in the cloud and we're going to do everything, and that's just not. This was just proof. Okay, so what happens when the economy shifts like it has, and you get labor tightens, you have inflation high, you've got interest rates rising, you've got the markets down as companies go into a strategic hibernation in terms of massive CapEx projects and also lift and shift transformational projects like moving their entire, ERP system to the cloud. So what that means is that legacy infrastructure and existing software that's been implemented in the company becomes more important. And key technology partners like those I named become critical. Now, add another layer. 3 or 4 years ago when Antonio Neri said, hey, we're going to do everything as a service on-prem, all of a sudden they actually added a layer of intrigue for all those companies now that need to get more from their resources that say, hey, you can stay on-prem, but you can benefit from a cloud operating model at the same time. And you can scale your business, get things done that you need, whether that's data, networking, security, and you can do it all with us, with a company like HPE. So GreenLake has been growing nicely for a long time, but you're talking about $1 billion in annual recurring revenue. Not a huge number yet. It actually is a huge number. It's just not a huge number, comparatively to the size of the company that's $30+ billion in revenue. But the corner is being turned. We've seen Dell, Cisco, IBM, and so many others moving to this really strong hybrid and on-prem cloud, these subscription services, these things that basically enable companies to scale, grow, and meet transformational needs with only moving that 10% to 20% of key enterprise workloads that are going into the public cloud. Well, beneficiaries are companies like HPE, and HPE was first to really go all in on this. They've come up with a very comprehensive set of services to address everything from, the not just compute, but also, the data services, security services, edge services. And so they've been very ambitious. And so we're starting to see that come to fruition. And this particular market condition is actually favorable for HPE, and it should be good for the company as we come out of it, and it should see the business grow faster. So you kind of hit all the segments. I wanted to hit the macros. We both had a chance to talk to Antonio Neri. We've both been cheering this on, and it was good to see some numbers. You said something, Pat, very salient, and that is it can't be one and done. Meaning this was the first, what I would say, really good overall quarter I've seen from HPE. They've had moments in parts of the business over the past several quarters. This was a good overall quarter. A few more of these, and maybe the public interest will really start to see some acceleration, like clearly the customer interest already has.
Good stuff. You're stuttering a little bit. Cheap hotel Wi-Fi, but I think it all.
You sound great. I haven't heard a single blip, so it's just my crappy internet connection, everybody. But hopefully it's StreamYard's processing this, and it's just Pat that can't hear me.
No, that would be good. Hey, let's go into another infrastructure darling here, a darling that keeps frickin' delivering time and time and time again. Remember, infrastructure is boring, right? Low growth. Holy crap.
Well, it doesn't have to be. So Pure Storage, Pat, our friend Charlie Giancarlo, CEO of Pure Storage, said to me on a Making Markets episode that, the external market condition doesn't matter to him as much because there's so much market share for him to get. I say,
that's so baller. I love that.
Yeah, and like I said, that wasn't verbatim, but that was effectively what he said is, look, at where we're at, it doesn't matter with the market. If we do what we do, we will continue to grow. And they're doing what they're doing, and they're continuing to grow. 26% year-on-year growth to 2.75 billion, Pat. Great little at a glance meme that you shared. I shared your share of Steve McDowell, storage analyst at Moor Insights and Strategy, came out with a good piece. Like I said, sometimes borrowing is the best. It's just faster. And, at a glance, kind of running this down, big energy savings. Company's got a good economical sustainability story at 80% is what up to 80% is what their customers see. They've grown to 11,000 customers, and Pat, that number, customer obsessed is the word of the day for Pure Storage. This is a customer obsessed company. Never seen a company post their net promoter score. Never seen an infrastructure company spend so much effort to share their net promoter score on their earnings. 85.2. It's in the top 1% of B2B companies. It's not even close. I mean, Pat, I think we're a 90 at Futurum Research because I made that up. But in all seriousness, it's just not a common behavior trait of B2B companies to be this customer obsessed. And they have done that extremely well. They're seeing their margin go up. They're seeing their subscriptions up 30%. Pat, storage, you could say it's boring, but it's necessary. And the company is doing it right, doing it in the cloud. They're doing the infrastructure, making it as a service, focusing on customers, economical sustainability. I'm repeating myself now. Sorry, it's kind of straightforward, but Charlie and team, congrats. This is a good result based on good work that's been done over the last several years. And I don't see it changing direction, Pat.
Yeah, I kind of view this as the Tesla of the storage industry. Everybody thought that Pure was doing so well because it was primarily a flash play, and flash means it's basically hardware, right? And when everybody else gets flash, everybody else is going to come and they're going to wipe out Pure. Well, what happened was very interesting. In fact, it's not a hardware play. I view Pure as a software play. Yes, it does have a very revolutionary architecture, particularly when it came out, but it's seemingly always one step ahead of the competition. First of all, from an architectural basis, why is Pure so good at ESG? Well, I wrote an article about this. Architecturally, what they use, it's more of a bladed architecture, that when you need a new capability, you don't throw out the entire array, you put in a new blade. 97% of Pure storage arrays are still in service. Think about that for a second. Upgrade your software. You upgrade the modules. You don't rip and replace and throw out the old version. You tag that up with as a service. And yes, this is the real deal. This is not greenwashing at all, because essentially you're lowering your costs, or you're having eye-bleeding performance for what you want to do for the likes of the largest hyperscalers out there. Yes, believe it or not, they can't talk about it a lot. A lot of the largest hyperscalers are using Pure Storage as opposed to using their own home-built or homegrown storage arrays. It truly is a success story, and I think it's also, in another way, it's also kind of an Apple play, which says nobody can make money in hardware. Well, actually, you can if you are chronically and constantly. First of all, change the game coming in. Like Apple, Pure was not the first storage array provider. In fact, it was like the 27th. All right. Apple was not the first smartphone provider. It was the 27th. What they did is they came in with something that was radically different. It was more software defined. and then service defined, then the hardware, don't get me wrong, the hardware is hot and the hardware is sexy, especially the upgradable architecture. But in the end, they keep moving forward because of their software, not because of their hardware. Great job, Giancarlo and team. We need to get him. We need to get him on the 6-5 investment show, don't we?
We do. He was a great guest on Making Markets and 6-5 on earnings. It's going to be a highlight of our 2023, Pat. We're going to be breaking this out. We're going to be bringing the CEOs in because, better together, the interviews are just better together. I give pretty darn good interview, and so do you, but I think together, this could be great.
Well, first of all, I think we are better. And secondly, I have a lot more fun than doing it alone. So, and there's a lot of value to that. Dan, when you're my age in 20 years, you'll understand that.
It's not that bad. It's like 18. Anyway, keep going.
There we go. By 18 in age, 13 years in true age. So no, let's go to the next one. Speaking of very profitable infrastructure companies, let's talk about Dell Tech. I mean, these guys, I thought they were just going to completely lay an egg because of the PC market, but they came out, they crushed profits by 43%, met on revenue, pretty light outlook, which hit them. Outlook was 16% lower than one before. Now, let's just stand back a second. 20% stock appreciation in 1 month. Okay, Bank of America just upped them to $55 bucks. I think a lot of it has to do with infrastructure, less about PCs, more about infrastructure. 7th consecutive quarter of growth, 30 ISG launches in 30 weeks. Sam Grocott and company on the marketing side are busy folks over there. Backlog did reduce. And I think unlike some of the other companies that we've talked to, like Cisco and HPE, there seems to be a little bit more of a burn off and less fill of the backlog than the other two vendors. PC market basically reflected the crappy PC market. Revenue was off 17%. From a profit point of view, though, Dell was insulated because it hits the highest margin segments and prioritizes that, whether it's the commercial market, gaming, and workstations. So all in all, a really good quarter. I mean, the supply chain folks who will never get mentioned here, I think deserve a tremendous amount of credit.
Yeah, first of all, it was a lot of fun having Dell on the 6-5, Pat. Sorry, I froze a little bit there. So, the 6-5 in the booths that we did with Dell, got a fun. So thanks, guys, for doing that. This is a little bit past time now. It's been a bit about a week and a half, right? This was a little bit before Thanksgiving. I got to tell you though, Pat, I was blown away. You said something like, I thought it was going to be terrible.
Yeah, wipe out.
I really did. And you know what? I stand by the fact that I didn't think infrastructure would be bad. I just thought PC would be terrible. And if you actually look at how the company was able to manage its operating margin, this company just has a way of managing its supply chain, its operations, and delivers profitability to its investors and shareholders. And you've got to love that, because this is a company that in good time and in bad time is going to figure it out. It continues to do that. It did it this quarter. As I said, Pat, you mentioned, and it was really important, they play in the right space in the PCs, that despite the fact that the numbers are slowing, and they're probably never going to return to the volumes that we saw during the pandemic, maybe ever.
Yeah.
They play at that premium tier, and the margin difference between that and those that are pumping out volumes of Chromebooks, it's a big difference, and that is reflected in the numbers that the company has. Company also has really done a good job with its infrastructure business. The infrastructure business continues to deliver. It's delivering growth. It's delivering profit. We talk about that slide where it's like, we're number one. We're number one at what, Pat?
Yeah.
We're number one at everything.
I know. By the way, I'm looking at that slide right now. I love it.
I mean, servers and storage and just you name it across the board, the company knows how to perform, execute, sell, and deliver to its shareholders. This was a good quarter for the company. But like I said, the PC business was down, therefore revenue was down, therefore they guided down. So it was, kind of one of those where you're like, looked at it, you're like, overall, this is really, really good. But at the same time, you can't come out and say we're going to guide up, and we can't say the company grew in every area. But I think they're in the right spaces. They're playing in hybrid cloud, they're playing in as a service, they're playing in to the security space, and I think in the long run, this is a company you can feel really good about. We know it's in the middle of this finalizing this spinoff of VMware. It's probably about to be done very, very soon. So it's continued connectivity to the public cloud and how they're going to handle that long term without VMware is something I continue to watch. But overall, I like the business, Pat. I like the result. And you really can't argue with a company that is dealing in a market that everybody thinks is garbage right now. I'm just saying, in PCs. And they actually showed the ability to be very resilient, deliver profit, and always keep the shareholders in focus, which is kind of the MO of Michael Dell and Jeff Clark.
Daniel, good analysis. Let's jump on to our final topic here, and that is Salesforce Earnings and Bret Taylor's departure from the company.
Yeah, I want to talk about the Taylor news. It totally clouded the whole earnings results. The earnings of the company are what they are. It actually beat, and it gave a positive year guidance, and it didn't matter much because when your CEO or co-CEO departs, that's always going to be seen as really negative. Bret Taylor was a good partner to Mark Benioff, but I said this on CNBC, say it again. Bret Taylor is not Mark Benioff. Bret Taylor did a nice job as a second. He was a guy that Mark Benioff had identified as a possible, CEO of the future. Mark has wanted to do more things politically. He's wanted to do more things in the community. And so there's always been a little speculation that he's been trying to find this. It would happen with Keith Block, but let's say that this video has been played once before. Mark Benioff brought in Keith Block, and it did not work out either. Now the question is this a Mark Benioff thing? The stock was the second worst performer on the Dow. It was down 40%. Now it's down more. Not necessarily because of bad results, just because SaaS is out of vogue. And when you're the CEO or the longtime founder of a company and the performance starts to wane a little bit, oftentimes you'll see that person kind of come back into the picture more. Just like Larry Ellison will always be Oracle, Mark Benioff will always be Salesforce, and he can put anyone else in that role. But as long as he's in the company in any capacity, he's always going to be the number one guy. And so for someone like Bret Taylor, who was, an entrepreneur, a founder, who came into the company through an acquisition, who meteorically rose into the company and got to the top, he probably realized that he was the co-CEO, but that was as far as it was ever really going to go. So maybe a partnership between someone like a Larry and a Safra can work. I don't know if the partnership with Mark works. Now, Mark clearly liked him. A couple pieces of speculation I'll touch on is one is, there was some speculation that the launches were a little light at Dreamforce, and that kind of created a little bit of pressure on Bret given the overall market conditions. There were also obviously what Bret said himself, that he wants to go back and explore his next entrepreneurial run. The inorganic acquisitions of Salesforce, while I do believe they will pay off long term, have not necessarily fully been realized. That's MuleSoft, that's Tableau, that's Slack. And of course, Quip is the company that came in, that Bret came in with, certainly has not realized its full potential yet. So there's still a lot of opportunity to take all these pieces, this house of brands that have been acquired by Salesforce, and putting them all together to make the most meaningful company, the quote unquote digital headquarters. Microsoft Teams has been a relentless competitor to Salesforce, and Salesforce's whole Salesforce plus Slack has a lot of work to be done if it's going to be a meaningful competitor. So while the company's earnings were actually pretty good, I mean, the growth has slowed. It's like the same speed as IBM now. So this is not a hyper growth company anymore. This is a company that's a very robust enterprise software and part of most large enterprises and even mid-sized enterprises sales organization, and has expanded into service and platforms and marketing and more. But I think right now, and I'm going to pass the baton over to you, Pat, the Brett thing will not be a long-term problem for the company. I wish Brett Taylor good luck. I hope we'll be seeing him soon somewhere else where we talk to him. Mark will step back in. Like I said, this movie's been played before, this record, this song, we've heard it. We'll see it. Mark will get it back running again. And, now the company has to figure out how to grow it even faster.
Yeah, investors want to see 20 to 25% growth out of a quarterly growth on from a company like Salesforce. And that's actually what they delivered for a long time, and they came in at 14%, which, by the way, I want to reinforce met expectations, right? And if I look at just the years, I mean, they nail it on the revenue side. Where they typically shine is on the profit side, and they beat on profits by 14.5%, which again, you look historically, is very well aligned with what they did before. So part of this is a market challenge. Their forecast was very light, and they also had the double witching of Brett living. And listen, the the talking point out of the company was that Brett wants to go back and hit his entrepreneurial roots. I do believe this, and I understand this. Trust me, I slogged it out for over 20 years in Fortune 100 tech companies, and there's just something special about going in and doing a startup, doing something smaller, and going for stratospheric growth.
Couldn't agree more.
I'm going to be very consistent too. If you look at my other analysis, I would like to see how the company can drive or organic growth in there. Acquisitions are strategically important. I think at least one out of the three acquisitions is absolutely paying off. I'm also very happy to see some of the lift from Customer 360. That was I think the real standout that came out from the earnings announcement. So dialing back, Salesforce is a required asset or a required service in some way, shape, or form if you are in the enterprise. It's building its stack to compete better with the Googles, the Microsofts of the world. Heck, we've even seen Zoom building their own stack, and not referring to a vertical stack, but more of an end-to-end stack that goes all the way from messaging all the way to the back end with core services that are more operational. So I am looking forward to the company's. They have an analyst event coming up in 2 weeks. I am going to be checking in. I'm going to be there with bells, and I'm going to be spending a lot more time digging into what the company can provide, how it's unique, and be weighing in on what changes I think it needs to make. So Daniel, buddy, it was great to see you. We got through this even with your hotel connectivity. You're probably the type of guy that didn't spend the extra $5 to get the added performance, because I know you're a belt tightener.
You know me so well, buddy. You know me so well. You know what's funny is I don't even think there was an option in this hotel, because I have the status with Marriott. I get it free. I just don't think it was there. But what's weird is, I'm looking at the speed. It's like 15 up and down. There's no reason a stream like this should have had any issues. It's been stable. And I just want to point out, you sounded great the entire show. I didn't have one skip of you at any point. I think for our viewers, that's really what matters. Because, I mean, Pat, in the end, it's not about what's in it for you, but what is in it for you? And I'm glad we were able to answer that question here today. It's always better together, but as long as we can hear Pat, the 6-5 shows will always rage on.
Man, what a close. I was going to try to work in a Succession meme myself, but you just took it, man. You stormed the friggin' gates, and you win. You win this show, Dan.
Even with my bad connection, I won the show.
I know. So you gonna be back sometime this weekend? We can hang out and be besties and not talk business.
Yeah, let's do that. I'll be back Sunday night before we leave again Monday morning to be at Marvell with the 6.5, doing our thing at the Avant launch, and then you and I off to the not Marvell, Lattice Semiconductor, the Avant launch, and then Marvell for the Industry Analyst Day. I mean, when you love what you do and you do it with the people that you love, is it even really business? And that's what I'd ask, not just you, buddy, but everyone out there that's part of our 6.5 community.
I don't know. In a way, we've kind of turned our businesses into our hobby. I mean, we freaking love it. So I love it. Do you love it?
I love it, man.
Okay.
I love it. And I
Hey,
love everyone out there.
I got to get off and I need to call my dad real quick.
You do need to call your dad.
Yeah. Do you need to call your dad?
You should probably call your dad. If you haven't watched Succession, then you don't get this. But if you have, I hope you find it as funny as we do.
Sorry, I'm going to stop cracking myself up. But hey, I just want to thank everybody for tuning in to the show. I thought it was a pretty good one. Had a lot of fun. We are remote. Check out all the 6.5 on the roads and in the booths that we did at AWS reInvent. We did it with Amazon, IBM, Dell, and MongoDB. Check them out. I think you'll like them. And give us some feedback. No, actually, we don't want any of your feedback. We just do whatever we want. No, I'm just kidding. Hit that subscribe button, folks. Take care. Have a good weekend and love you all. See you, besties.